Powell drops another bombshell. Dovish remarks spark the market as a big rally in U.S. stocks about to begin. Friends, over the past few days, one word has been dominating Wall Street: rate cut. Fed Chair Powell's dovish shift sparks the market. The Dow Jones has hit a record high, while the US dollar has weakened. Previously, Trump repeatedly issued strong public criticisms of the Federal Reserve, accusing its monetary policy of dragging down the US economy. More importantly, he even hinted that if he were to return to the White House, he would take more aggressive measures to curb the Fed's power. This statement immediately drew significant market attention. On one hand, investors worried that the Fed's independence could be undermined, creating greater uncertainty for future monetary policy. On the other hand, with U.S. equities currently at elevated levels, any disturbance could trigger sharp volatility. The U.S. economy is at a particularly sensitive stage. While inflation has eased somewhat, it still remains above the Fed's target range. At the same time, growth momentum has begun to slow. The market is highly sensitive to expectations about the path of interest rates. Friends, I'm chinking. With 5 years of investment experience in the U.S. stock market, I break down key insights and information to make financial knowledge easier to understand. Against the current backdrop, Trump's new big move is not just a political statement. It could become a fresh spark for market volatility. This leaves investors facing a critical question. Will Trump's confrontation with the Federal Reserve trigger a new downturn in U.S. stocks? Will Trump's remarks undermine market confidence? What impact could they have on the market? Finally, which sectors of the stock market might also be affected? Before we dive into the video, I'd like to ask you to leave a comment and share your thoughts. If you find my videos helpful, feel free to subscribe for free. Your support is what motivates me to continue producing in-depth analysis. At the end of this video, I'll provide clear recommendations to help you effectively avoid potential risks from this event and identify possible opportunities. In U.S. political and financial circles, the conflict between Trump and the Federal Reserve is nothing new. During his previous term, Trump repeatedly criticized then-Fed Chair Jerome Powell's rate hike policies in public, calling it a killer of the economy. He even directly blamed stock market volatility on the Federal Reserve's missteps. For Trump, the performance of the stock market is almost a barometer of his political achievements. And the Fed's tightening policy is clearly the last thing he wants to see now. With the election approaching, Trump is once again going big. In his speeches and media interviews, he has been loudly and repeatedly calling on the Federal Reserve to cut interest rates as soon as possible. He has even hinted at restricting the Fed's independence at the institutional level. In other words, he believes the Fed is too independent, and that such independence actually hinders us. He condones prosperity. This stance is not merely an economic disagreement, it is a carefully crafted political strategy. Through a war of public opinion, Trump portrays the Fed as a Wall Street elite institution blocking economic growth, while casting himself as the defender of ordinary Americans' wealth. This positioning is clearly aimed at further winning over voters. The underlying motive is clear. During an election campaign, economic performance and stock market trends are among the most persuasive factors for voters. By continuously pressuring the Fed, Trump can either force a policy shift toward easing or shift the blame for any future economic slowdown. Blame it on the Fed's dereliction of duty, no matter the outcome. Trump stands to gain political capital. But for the markets, this high-profile confrontation adds greater uncertainty to monetary policy. Investors are now forced to weigh the risk of a potential policy shift against the risk of political interference spiraling out of control. So here's the question. Do you think the Fed will withstand Trump's pressure, or will it be forced to compromise before the election? Share your thoughts in the comments below. Despite Trump's relentless pressure, the Federal Reserve continues to stick to its own policy logic. As the world's most influential central bank, it's shouldering a dual mandate. It must both maintain full employment and ensure price stability. Over the past year, U.S. inflation has eased somewhat but still remains above the Fed's long-term target. This means that cutting rates too early or too quickly could risk triggering a new wave of inflation at the same time. Signs of slowing economic growth are emerging. Striking the right balance between fighting inflation and preventing recession has become the Fed's most critical challenge. In terms of its stance, Fed officials have repeatedly emphasized the independence of monetary policy. They have made it clear that political factors will not dictate their decisions, even as Trump continues to apply public pressure. Powell's team has repeatedly stressed data dependence in statements and meeting minutes to steady market sentiment. On the operational front, the Fed is very likely to remain cautious in the short term. It will continue to wait and see until key indicators such as employment and inflation become clearer. If the economy does show significant downside pressure, the Fed may adopt a gradual rate cut approach to maintain flexibility, while at the same time avoiding the impression that it is bowing to political pressure. For the markets, the Fed's true impact has never come from rhetoric but from its actual actions. If the Fed maintains its independence, it could put short-term pressure on stocks but would preserve long-term policy credibility. Conversely, if markets sense the Fed is yielding to political pressure, equities may rally in the short run, but it could face a credibility crisis in the future. The most direct consequence of the confrontation between Trump and the Federal Reserve is a rise in market uncertainty. In the short term, investor sentiment is highly susceptible to shifts in public opinion and policy expectations. If the market believes the Fed may be forced into an easing stance under political pressure, U.S. equities could see a rebound. But if the Fed holds firm to its independence and remains hawkish, stocks may come under downward pressure, especially with U.S. equities already trading at elevated levels. Any disturbance could be magnified and quickly trigger sharp volatility. From a medium to long-term perspective, the ultimate outcome depends on the policy direction. If the Federal Reserve accelerates rate cuts, liquidity will become more abundant, allowing the high valuation logic of tech and growth stocks to continue. If the conflict escalates, however, concerns over the Fed's independence may push up risk premiums, compress overall valuations, and even trigger a deeper market correction. At the same time, sector divergence may widen further. Tech stocks, being most sensitive to interest rates, could continue to benefit. Financials may come under pressure from narrowing spreads, while energy and cyclical stocks will depend more on global demand. More importantly, changes in market psychology cannot be ignored. After a prolonged rally, U.S. equities are already trading at elevated valuations, and investors' willingness to chase gains has weakened. In this context, the clash between Trump and the Fed could easily become a justification for some investors to lock in profits. At the same time, safe haven flows may shift into gold and U.S. Treasuries, putting further pressure on market liquidity in U.S. equities. If you find this kind of in-depth breakdown helpful, please give me a like and subscribe for free this way. You won't miss my latest tracking and analysis of U.S. tech stocks. In summary, the confrontation between Trump and the Federal Reserve essentially reflects a clash between short-term political demands and long-term financial stability. The future trajectory will depend on inflation levels, the degree of market stress, and whether the Fed can maintain its independence. For investors and the market, this is a major source of uncertainty that warrants close attention. In the short term, it will increase volatility. In the longer run, outcomes will hinge on policy, direction, and market confidence. For investors, it is both a risk and an opportunity. If you're also following the future direction of U.S. stocks, don't forget to give this video a like, subscribe to the channel, and share your thoughts in the comments. Do you think the Fed will stick to its independence or shift under political pressure? Looking ahead, the tug-of-war between Trump and the Federal Reserve could give rise to several different market scenarios. In the first scenario, Trump's pressure proves effective, and the Federal Reserve shifts to an accommodative stance earlier than expected. If this outcome materializes, U.S. stocks are likely to see a liquidity-driven rebound in the short term, with technology and growth stocks benefiting the most. However, such political interference would undermine the Fed's independence, erode its long-term credibility, and could eventually trigger even greater market turmoil. The second scenario, the Federal Reserve maintains its independence and refuses to yield to political pressure. In the short term, the stock market may react negatively to this hawkish stance, leading to volatility or even a correction. However, from a long-term perspective, such determination helps safeguard the stability of the financial system, strengthens global investors' confidence in USDOLLAR assets, and may ultimately be reinterpreted by the market as a long-term positive. The third scenario, the overlap of external variables further amplifies volatility. For instance, a global economic slowdown, frictions in U.S.-China relations, uncertainties surrounding the Russia-Ukraine conflict, and sharp fluctuations in energy prices could all intensify the impact of domestic policy tensions in the United States. Once risk-off sentiment rises, capital may flow heavily into gold and U.S. Treasuries, squeezing the valuation space for U.S. equities and significantly increasing market volatility. It is important to emphasize that these scenarios are not mutually exclusive and may occur alternately at different stages. What investors truly need to focus on remains the economic fundamentals. Inflation, employment, and growth are the core variables that determine the Federal Reserve's policy. Political conflicts are more of an external noise, but in a fragile, high-level market environment, they can still serve as the spark that ignites volatility. The market's main focus is on the Federal Reserve's independence and policy direction. Trump has publicly called for Fed Governor Lisa Cook to resign and has even suggested the possibility of dismissing her. However, the immediate impact on monetary policy appears limited. The U.S. dollar index is fluctuating around 98.30, reflecting a tendency toward stability. Investors are instead focused on whether Chair Jerome Powell will signal a potential September rate cut at the upcoming Jackson Hole Symposium. At the same time, markets are pricing in an 82 to 83% probability of a 25 basis point cut in September. Short-term Treasury yields remain steady, while the yield curve has steepened, indicating market bets on future easing. Meanwhile, fiscal pressures are heightening concerns over the risk of fiscal dominance. Trump's push for rate cuts to lower the government's interest expenses has amplified this risk. Markets worry that if the Fed were to come under fiscal pressure, it could undermine both its ability to fight inflation and its overall policy credibility. As these risks escalate, policy contradictions are becoming more apparent. For example, the misalignment between tariffs and the Fed's policy objectives. Trump has imposed tariffs to gain policy leverage while simultaneously urging the Fed to cut rates to stimulate the economy. This contradictory policy mix is widely viewed by academics and markets as a form of policy mismatch, which could distort monetary policy expectations. Experts warn that such inconsistencies may intensify market volatility and further erode the Fed's independence. So what specific impacts and lessons might this bring? Before we dive in, I'd appreciate it if you could give this video a like, leave a comment, and subscribe. Overall, the clash between Trump and the Federal Reserve may look like a battle between politics and policy on the surface, but its deeper impact lies in the stability of market expectations. Whether US stocks experience a major sell-off doesn't depend solely on the intensity of Trump's rhetoric, but rather on whether the Fed's policy direction undergoes substantive change and how investors interpret the uncertainty created by this conflict. Looking ahead, the trajectory of U.S. equities will largely be shaped by three key factors. First, the Federal Reserve's interest rate policy. It will directly affect market liquidity and the valuation anchor. Second, investor confidence determines whether capital keeps flowing in or retreats. Third, the global economic and geopolitical environment. This may either amplify or mitigate the impact of domestic tensions in the United States. In other words, the conflict between Trump and the Federal Reserve is more like a fuse than the sole force determining the trend of U.S. hedging against risks. This is essential because in an environment of rising uncertainty, safe haven assets such as gold and U.S. Treasuries should have a place in the portfolio. Second, structured opportunities still remain. Different sectors show varying degrees of sensitivity to interest rates and policy. Third, maintain a long-term perspective, even if S stocks experience short-term volatility. It does not mean that the long-term trend has reversed. Chasing rallies or panic selling blindly will only increase risks. In this sense, the tug-of-war between Trump and the Federal Reserve may continue to play out repeatedly. However, what truly determines the direction of the U.S. stock market remains the economic fundamentals. If investors can stay calm amid political instead, new opportunities may be found amid the turbulence. If you are also following the tug-of-war between Trump and the Federal Reserve and its impact on U.S. stocks, feel free to share your thoughts in the comments section. Well, that's all for today. If this is your first time visiting my channel, don't forget to subscribe and turn on the notification bell so you can get my latest pre-market and after-hours analysis of U.S. stocks right away. And remember to leave a comment below and tell me, in what ways has the dispute between Trump and the Federal Reserve See you next time.